Not many knows that there are a lot of financial equities that we are able to trade. There are a few instruments that people are common and also not familiar with when trading in a financial market. They are stock or the share price of a company, options, futures, bonds, mutual fund, and exchange traded fund. In this video, we will go through briefly one by one. Beside normal share that we are commonly trade, there is options and warrant. An option is a financial derivative that represents a contract sold by one party, which is the option writer, to another party, which is the option holder. The contract offers the buyer the rights, but not the obligation to buy or sell a security or other financial asset at an agreed upon price during a certain period of time on a specific date. Options is an alternative of investment of the share price themselves. The name is almost identical to the mother share, but it sells at a cheaper price. This makes options really attractive as it has a cheaper price and has the ability to move faster compared to its mother share. This allows traders to use options as their leverage, by meaning that it can move faster than the mother share itself and subsequently give more profit potential in a short time frame to the holder. It has also enabled investors with low capital to invest through this vehicle. But everyone has to know that options has its maturity date, by meaning anyone who invests in those equity must check the expiry date to avoid any total loss. Option or warrants is not the share price of the company, thus it is not entitled any dividend or bonus unless a person buy the share of the company. Beside option and warrant, we have a financial equity that called futures. Futures are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or financial instrument, at a predetermined future date and price. Futures contracts detail the quality and quantity of the underlying asset. They are standardized to facilitate trading on a futures exchange. Some futures contracts may call for physical delivery of the asset, while others are settled in cash. As almost the same as option and warrant, it provides people to leveraging an asset that is normally commodity such as corn, palm oil, gold, or an index. This instrument involve high risk but at the same time for a greater profit potential in a short time frame. People can rely heavily on technical analysis on buying and selling futures. It is too liquid and high in volume that people are able to trade even in hours or minutes. A bond is a debt investment in which an investor loans money to an entity, which is typically corporate or government, which borrows the funds for a defined period of time at a variable or fixed interest rate. Bonds are used by companies, municipalities, states, and sovereign governments to raise money and finance for a variety of projects and activities. The fixed interest rate can be like about 6% per year for an agreement minimum of 3 years. It can be lasted more than that depend on the contract agreement. Because the entire project is sometimes very big, only really high net worth individual that seeking fixed return income for every year opt to choose this vehicle. Bond is considered to be slow but safe, yet everyone does not guarantee their investment in the future. When you invest in the stock market, there is a type of investor that only specialize on some certain financial vehicle, for example like the exchange traded fund. In the US, the ETF would be US Dow Jones, S&P 500 or Nasdaq. Traders opt to invest at the index ETF because it is less volatile and predicted If compared with individual share price of a company, this yield a safe and reliable predicted return sum of profit every year. In addition, there is an option traded in the index. Under exchange traded fund, there is individual companies that make the index. For example, there is 500 big influential companies under S&P 500. Each performance of the stock market may affect the performance of the index. At the bad market movement, overall movement of individual companies' share price will tend to move down too, and vice versa. All investing in every financial equities may result in different return profit potential. Your ability as a trader is to define your risk before getting in any financial equities so that it is safe for you to invest and having consistent profit in the long run. In the risk management section, I will share with you on how to take care of your risk management.